You didn't lose money because the breakout failed. You lost money because the breakout worked just long enough to convince you it was real. Think about that for a moment. The price pushes above a previous swing high. Volume expands. Momentum looks strong. You finally get confirmation. So you buy. And then, almost without warning, the market reverses and leaves you holding the position while stronger hands sell into your enthusiasm. Have you ever noticed how often your confidence peaks right before the trade starts hurting? That's the nature of the swing high trap. A swing high is obvious. Everyone can see it. It's the point where price previously turned lower. Traders mark it on their charts, place alerts around it, and wait for the breakout. The problem is not that the level is important. The problem is that everyone is looking at the same level in the same way. And when too many participants expect the same outcome, the market often finds opportunity in disappointing them. Why does price move above the swing high in the first place? Because liquidity lives there. Above every swing high sit stop orders from short sellers and breakout orders from eager buyers. Together, they form a pool of fuel. When price reaches that area, large operators can access the liquidity they need. The breakout attracts demand. The stops provide additional buying pressure. The market suddenly has enough volume to facilitate larger transactions. But here's the question few traders ask. Who is selling into that buying pressure? When a breakout is genuine, price usually accepts above the level. It holds. Pullbacks remain shallow. Buyers continue to support higher prices. A trap behaves differently. Price breaks above the swing high, but it struggles to stay there. The move becomes stretched. Follow-through weakens. Buyers who arrived late find themselves trapped when price slips back below the breakout point. The reversal isn't random. It's the consequence of demand being exhausted after liquidity has been harvested. This is where psychology becomes dangerous. The trader sees the breakout and feels relief. Relief creates urgency. Urgency reduces judgment. Instead of evaluating the quality of the move, they focus on the fear of missing it. Have you ever entered a breakout because you didn't want to watch it run away without you? That emotion is often the first warning sign. A practical observation is simple. Don't judge a breakout by the moment it crosses a swing high. Judge it by what happens afterward. Does price hold above the level? Does it attract fresh participation? Does the market spend time above resistance instead of immediately rejecting it? The answers matter more than the breakout itself. Another clue is the quality of the candles approaching the level. When price races vertically into a swing high after an extended move, be cautious. Aggressive movement often attracts emotional buyers. Emotional buyers create vulnerable positioning. Vulnerable positioning creates the conditions for a trap. The experienced trader understands that the market rarely rewards obvious behavior for long. Instead of chasing the first move, they observe the reaction. Instead of assuming strength, they look for proof. Instead of buying excitement, they study acceptance. The interesting opportunity is rarely the move above the swing high. It's what happens after. Watch a chart long enough and you'll notice a pattern. Price pushes through a well-known high, attracts attention, and then quickly falls back below the level. At that moment, most traders are focused on the breakout that failed. They are looking backward. The experienced operator is looking forward, because a failed breakout creates a new question. What happens when price returns to the scene of the trap? The initial rejection tells you something important. The market tested higher prices and could not maintain them. Supply was strong enough to overcome the buying pressure that carried price above the swing high. That information has value, yet information becomes useful only when the market confirms it again. This is where the retest enters the picture. After the rejection, price often moves away from the level. Then, after some time, it comes back. The market revisits the area where buyers were trapped and where sellers previously gained control. Why is this return so important? Because the first rejection reveals possibility. The retest reveals commitment. A single reversal can occur for many reasons. Temporary profit-taking, short-term order flow, random volatility. But when price returns to the same area and fails again, the message becomes harder to ignore. The market is showing that the previous rejection was not an accident. Think about the sequence. The The breakout attracts buyers. The failure forces some of those buyers into losing positions. The pullback creates distance from the level. Then the retest offers trapped participants another chance to escape. That matters because exits create supply. Supply creates resistance. Resistance increases the probability of another rejection. The market is not merely revisiting a price level, it is revisiting unfinished business. Have you ever noticed how often the cleanest moves begin after a second test rather than the first? The reason is simple. The first event creates information. The second event confirms it. A trader who enters immediately after the failed breakout is acting on a single piece of evidence. A trader who waits for the retest is acting on evidence that has survived another examination. Patience changes the quality of the trade. The goal is not to predict that a breakout will fail. The goal is to observe that it has failed and then watch how the market behaves when given another opportunity to move higher. If buyers are truly strong, the retest should succeed. Price should reclaim the level and hold above it. If buyers are weak, the retest often exposes that weakness. Price approaches the level, hesitates, struggles, and turns away again. The reaction becomes more important than the level itself. This distinction separates observation from assumption. Too many traders become fascinated with where price is. Professionals become interested in how price behaves when it gets there. The retest creates a controlled environment for observation. The market has already revealed one piece of its hand. Now you're watching to see whether it plays the same card twice. And when it does, something begins to change. The trade is no longer based on a breakout. It is no longer based on anticipation. It is based on demonstrated behavior. That shift may seem small, but over time it changes the entire quality of decision making. You stop chasing events and start evaluating reactions. You stop paying for possibility and start paying for evidence. At first glance, a swing high trap seems inefficient. Price breaks above resistance, attracts buyers, and then reverses. The breakout fails. The participants who bought the move are trapped. It appears messy, wasteful even. But markets do not exist to move in straight lines. They exist to facilitate transactions. And that changes how you should think about the trap. Consider a simple question. If large interests wanted to establish meaningful positions, where would they find enough activity to do it? Not in quiet areas. Not where nobody is trading. They need participation. They need volume. They need counterparties willing to take the other side of a transaction. A swing high naturally attracts attention because it is visible. Traders watch it. Orders gather around it. Activity increases as price approaches it. The level becomes a magnet for participation. That participation serves a purpose. The market cannot discover whether higher prices are sustainable without first testing them. A breakout is one way of conducting that test. Price moves beyond the known boundary and explores what exists on the other side. Sometimes the answer is clear. Demand remains strong and the market continues higher. Sometimes the answer is equally clear. Demand disappears, participation fades, and price falls back below the level. The trap is not proof that the breakout was pointless. The trap is evidence that the test produced a result. Think about it this way. If no breakout occurred, the market would never know whether buyers were willing to support higher prices. The test itself is necessary. The failure simply reveals the outcome. This is why swing high traps continue to appear decade after decade. They are not a flaw in the market mechanism. They are part of the market mechanism. The market constantly searches for balance between competing interests. To find that balance, it must probe areas where uncertainty exists. A swing high represents one of those areas. Price pushes beyond the level because the market is asking a question. The reversal occurs because the market receives an answer. Have you ever noticed that the strongest information often comes from what the market cannot do rather than what it can? A market that cannot remain above a breakout level is revealing a limitation. That limitation becomes information. Information influences future behavior. Future behavior shapes the next move, because leads to effect. The breakout creates a test. The test reveals acceptance or rejection. The result guides subsequent price movement. Viewed through this lens, the swing high trap is not an exception to normal market behavior. It is a normal market behavior. This perspective matters because it changes what you're observing. Instead of seeing a trap as a random event, you begin seeing it as a discovery process. The market explored a higher price zone and determined that conditions there were insufficient to support continuation. The failure itself becomes data, and valuable data often emerges from failed attempts. A business learns from an unsuccessful product launch. An engineer learns from a failed design. A market learns from a failed breakout. The principle is the same. Progress does not require every test to succeed. Progress requires information to be gathered. That is why swing-high traps persist even though they fail so often. Their purpose is not to create successful breakouts. Their purpose is to reveal whether success is possible in the first place. Once you understand that, the chart begins to look different. The breakout is no longer the final event. It becomes part of a larger investigation being conducted by the market itself. A swing high is not important because it marks a previous turning point. It is important because it attracts orders. That distinction changes everything. When traders look at a chart, they tend to focus on price. The market, however, responds to orders. Price is simply the visible result of those orders interacting with one another. Above a swing high, orders begin to accumulate. Some belong to traders who sold short and placed protective stops beyond the high. Others belong to breakout traders waiting to buy if price moves through resistance. Different intentions, different participants, yet they are concentrated in the same area. This concentration creates something valuable, liquidity, and wherever liquidity becomes concentrated, the market pays attention. Think about why price often accelerates as it approaches a major swing high. The closer price gets to the level, the more market participants become involved. Activity increases, anticipation increases, order flow increases. The level starts behaving like a magnet, not because the market respects lines on a chart, but because those lines represent locations where business is likely to occur. A market cannot move efficiently without transactions. Large transactions require willing counterparties. Liquidity provides those counterparties. This is why isolated price levels matter. Not because they possess mystical significance, because they gather interest. Have you ever wondered why price sometimes moves through a swing high with surprising speed? The answer often lies in what exists beyond the level. As price breaks higher, short sellers are forced to buy back positions. At the same time, breakout participants enter new long positions. Buying pressure increases from both directions. One group is buying by choice. The other is buying by necessity. The result is a temporary surge in activity. Notice what this means. The movement above the swing high is not necessarily evidence of strength. It may simply be evidence of liquidity being activated. Those are not the same thing. Strength tells you something about future direction. Liquidity tells you something about current participation. Confusing one for the other leads to misunderstanding. The market is often less interested in the breakout itself than in the orders waiting around it. Once you begin viewing swing highs as pools of liquidity rather than resistance levels, the chart starts revealing a different story. You stop asking, will resistance hold? You start asking, what orders are likely gathered here? That question shifts attention from price patterns to market behavior. Cause and effect become easier to see. Orders accumulate. Liquidity develops. Price is drawn toward liquidity. Transactions occur. Then the market reacts to the outcome of those transactions. The sequence matters. Without liquidity concentration, there would be little reason for the market to focus on a particular swing high. The level becomes significant precisely because participants have collectively made it significant through their positioning. The market is responding to the crowd's commitments. Every stop order, every breakout order, every pending instruction contributes to the importance of the area. The swing high becomes less like a line and more like a gathering place, and gathering places attract activity. This perspective also explains why some swing highs produce dramatic reactions while others barely matter. The chart may display two identical, looking highs, but if one contains substantial liquidity and the other does not, their outcomes can be completely different. Price structure may look the same. Order concentration may not. The market responds to the second reality. That is why experienced operators learn to think beyond the visible pattern. The pattern is only a footprint. The real story lies in the business being conducted around it. The market often gives confirmation before it gives acceptance. And the difference between those two things is where many costly decisions are made. A swing high trap usually begins with confirmation. Price moves above a previous high. The breakout becomes visible. The chart appears to validate a bullish idea. From a distance, the evidence seems complete. The level has been broken. The market has confirmed the move, but has it accepted it? That is a different question. Confirmation is an event. Acceptance is a process. The event happens quickly. A single candle can create it. A brief surge in buying can create it. Sometimes only a few moments separate confirmation from the appearance of a valid breakout. Acceptance takes longer. The market must prove that higher prices can be maintained. Participants must continue transacting at those levels. The breakout must survive contact with reality. Until that happens, confirmation remains incomplete information. Have you ever noticed how often a breakout looks strongest at the exact moment it occurs? That observation is not accidental. The breakout candle captures attention because it displays movement. Movement creates visibility. Visibility creates conviction. Yet conviction generated by movement alone can be misleading. A market can move somewhere briefly without being willing to stay there. This is why confirmation and acceptance must be separated. One tells you where price went. The other tells you whether the market agreed with the move. Cause an effect becomes clearer when viewed this way. Price breaks above the swing high. Confirmation appears. Participants interpret the breakout as evidence of strength. Orders enter the market. Then acceptance begins its examination. Can higher prices attract continued participation? Can the breakout maintain its position? Can the market build upon the initial move? Only time can answer those questions. The chart cannot answer them at the moment of confirmation because the necessary information does not yet exist. That creates a subtle problem. The desire for certainty arrives before certainty is available. A trader sees confirmation and feels compelled to act because the breakout appears to resolve uncertainty. In reality, the most important uncertainty remains unresolved. Will the market accept the new price territory? The answer emerges afterward, not beforehand. This is why acting solely on confirmation often carries a hidden cost. The decision is being made before the market has finished presenting its evidence. Imagine a business announcing an ambitious expansion plan. The announcement is confirmation. The successful execution of that plan is acceptance. Treating the announcement as proof of success would ignore the outcome that still needs to unfold. Markets operate in a similar way. The breakout announces intent. Acceptance determines whether that intent becomes reality. Once you recognize this distinction, charts begin to communicate differently. The breakout itself becomes less important than the behavior that follows it. You start paying attention to persistence. You observe whether price can remain above the level. You watch whether participation continues after the initial excitement fades. The focus shifts from the moment of movement to the quality of movement. That shift changes how information is evaluated. Instead of asking, did price break the swing high? You begin asking, what happened after it broke? The first question identifies confirmation. The second question investigates acceptance. And those questions often lead to different conclusions. Because markets frequently confirm ideas they later reject, the breakout occurs. The signal appears. The chart seems to agree. Then acceptance quietly refuses to cooperate. Price drifts back below the level. The move loses support. The breakout that looked decisive begins revealing that it was never truly embraced by the market. One of the most useful habits a trader can develop is learning to observe a breakout before participating in it. Not because every breakout is dangerous, because every breakout reveals information before it reveals its outcome. A swing high trap rarely appears without warning. The warning is often subtle, but it is there. The challenge is that traders tend to focus on the breakout itself rather than the conditions surrounding it. The move receives attention. The environment that produced the move is ignored, yet the environment often contains the clues. Before price reaches a swing high, something has already happened. The market has traveled a path to get there. That path matters. Ask yourself a simple question. How did price arrive at the level? A market that approaches a swing high in a steady, controlled manner often behaves differently from one that rushes into the level with unusually aggressive momentum. The reason is straightforward. The character of the approach affects the quality of the breakout attempt. An exhausted move frequently arrives at resistance, carrying less fuel than it appears. The distance traveled may look impressive, but the remaining capacity for continuation may be limited. Observation begins long before the breakout occurs. It begins during the approach. Another detail worth studying is the amount of time price spends beneath the swing high. Some levels are tested repeatedly before a breakout attempt develops. Others are attacked almost immediately after forming. These situations are not identical. Time represents interaction. The more time spent around a level, the more information the market gathers about it. The less time spent, the less information has been exchanged. That difference can influence what happens when the breakout attempt finally arrives. Notice what this process does. Instead of asking whether price will break through resistance, you begin studying the conditions surrounding the attempt. The focus shifts from prediction to observation, and observation tends to improve judgment because it relies on evidence rather than expectation. There is another element that deserves attention: the behavior of price immediately before the breakout. Does the market continue advancing smoothly, or does progress begin slowing? Does each push higher cover meaningful ground, or are advances becoming smaller? These details matter because markets often communicate changes in condition before they communicate changes in direction. A weakening advance does not guarantee failure, but it provides information. And useful observation is built from information gathered before conclusions are formed. Have you ever noticed that the clearest chart patterns often become obvious only after the move has already happened? That is because most people analyze outcomes. The professional observer studies development. The goal is not to identify certainty. The goal is to identify context. Context allows the trader to evaluate the breakout attempt with greater depth. Without context, every move above a swing high appears similar. With context, differences begin to emerge. One breakout develops after a measured advance. Another develops after an extended and increasingly strained move. One level has been carefully tested. Another has barely been explored. The breakout may look identical in both cases. The conditions behind it may be completely different. This is why observation should be treated as a process rather than a reaction. The market starts telling its story before the breakout candle appears. Each phase of the approach adds another piece of information. Each interaction with the level adds another clue. When those clues are collected consistently, the trader develops a framework for evaluating breakout conditions before commitment becomes necessary. A swing high trap does not become important because it fails. It becomes important because sometimes that failure develops into something much larger. The initial rejection above a swing high is only the beginning of the story. What matters next is whether the market simply corrects the excess or whether the rejection starts attracting enough selling pressure to change the direction of the move itself. Those are two very different outcomes. One creates a temporary pullback. The other creates a trend reversal. The challenge is that both outcomes often begin the same way. Price breaks above the swing high. The breakout fails. The market turns lower at first. There is little visible difference between a routine rejection and the early stages of a larger reversal. The distinction emerges over time, and that distinction is where trade management becomes important. Have you ever noticed how traders often become focused on the entry while paying less attention to what happens afterward? Yet the market rarely reveals its full intentions at the moment a position is opened. Information unfolds gradually. A failed breakout may initially produce a modest decline. If selling pressure remains limited, the move may simply fade into a normal correction. But if additional sellers continue entering the market, the character of the decline begins to change. What started as a rejection starts becoming a directional move. This progression matters because trade management should adapt to changing information. A trader managing a position based on a failed breakout is not managing a prediction. They are managing an evolving situation. Each new movement provides evidence. Each new reaction either strengthens or weakens the original premise. Cause and effect become visible. The breakout fails. Selling pressure emerges. Price moves lower. Additional weakness attracts more participation. The decline gains structure. The structure begins reinforcing itself. At some point, the market may stop behaving like a failed breakout and start behaving like a new trend. That transition is critical. The largest opportunities often emerge when a market continues moving long after the original trigger has faded from memory. The swing high trap creates the initial imbalance. The trend reversal creates the sustained movement. One leads to the other. But not always. That uncertainty is precisely why management matters. The objective is not to assume that every trap will become a major reversal. The objective is to remain responsive if it does. A position should be managed according to what the market is doing, not according to what the trader hoped it would do. This sounds obvious, yet it becomes surprisingly difficult in practice. Why? Because expectations tend to freeze perception. Once a trader decides that the move should be small, evidence suggesting something larger can be overlooked. The market, however, does not care about those expectations. It simply continues expressing supply and demand. A useful observation is to watch whether weakness remains isolated or begins spreading through subsequent price action. An isolated rejection often struggles to generate follow-through. A developing reversal tends to create additional evidence of weakness as time passes. The difference is not found in a single candle. It is found in persistence. Persistence transforms events into trends. This is why management requires ongoing evaluation rather than fixed assumptions. The market is constantly answering a question. Is the failed breakout merely correcting excess enthusiasm, or is it exposing a deeper shift in conditions? The answer reveals itself through continuation. If continuation fails, the rejection remains limited. If continuation strengthens, the implications expand. One of the oldest mistakes in speculation is assuming that price moving higher automatically means strength. The two often appear together. But they are not the same thing. A swing high trap exposes this confusion better than almost any other chart pattern. Price breaks above resistance. The market prints new highs. The breakout looks impressive. To the eye, strength seems obvious. Yet appearance and reality are not always aligned. The mistake begins when traders treat movement as proof. A breakout is evidence that price has moved beyond a previous boundary. Nothing more. It does not automatically explain why the move occurred. It does not guarantee that the move can continue. It does not reveal the quality of the buying that produced it. Those are separate questions, and separating those questions is where understanding begins. Have you ever looked back at a failed breakout and wondered why something that appeared so strong collapsed so quickly? The answer often lies in the assumption itself. The market moved higher, so strength was assumed. The assumption replaced investigation. Instead of asking what caused the move, traders accepted the move as its own explanation. But movement can occur for different reasons. A market can rise because buyers are aggressively accumulating. A market can rise because sellers are being forced to cover positions. A market can rise because orders concentrated above a swing high have been activated. The result looks similar on a chart. The underlying conditions may be completely different. This distinction matters because future behavior depends on the cause, not merely the appearance. Imagine two buildings illuminated at night. From a distance, both appear equally bright. One is powered by a stable electrical system. The other is powered by a temporary generator. The light looks identical. The durability behind it does not. Markets often present the same illusion. Price moving above resistance is visible. The foundation supporting that move is less obvious. That foundation determines whether higher prices can be sustained. Cause and effect operate quietly. If the breakout is supported by genuine demand, participation tends to persist. If the move is driven primarily by temporary order flow, participation may fade once those orders have been absorbed. The chart initially displays the same upward movement in both situations. Only later does the difference become visible. This is why equating price beyond resistance with strength is such a costly mistake. The trader becomes focused on location instead of quality. The breakout occurred. Therefore, strength must exist. The logic appears reasonable. The evidence, however, remains incomplete. A market can temporarily occupy higher territory without establishing control over it.